Hello everyone and welcome to the Financial Tribune. This is Plamen and today we'll be discussing the news about the Fed increase. It's just from today, the 14th of December 2022. And I just want to make a short review of the current market situation, what has the Fed stated about their future measures and how it's going to affect us in the near future. So let's get it on. So after the meeting today, the Fed stated that they will increase, as expected, the interest rate by half a point to a range of 4.25 to 4.5, which is the highest since December 2007. So the consumer price index in the United States rose from 7% in October 2022 to 7.1% in November, which is still a lower increase than what it has been expected. So this fact shows that the measures taken from the Fed by those interest rate hikes are showing results in the end, and the expected increase of 0.5% is now a fact. So they'll increase the interest rate by 0.5%, which will make borrowing money a little bit more expensive for companies. And that measure has the goal to decrease further the inflation that we are experiencing at the moment. But as I already stated, usually the goal of a healthy modern economy is about 2% inflation. But that 7.1%, it's still quite high. Although the Central Bank of the United States have decreased the hike rates, which are really steep this year, they will need to increase further, probably not at such a high pace, but that 7.1% inflation rate, it's still way higher than what we need to experience, meaning that prices will go even higher. They still need to decrease even further the inflation to 2%, and by decreasing the interest rate hikes, they're trying to do that at a slower rate in order to avoid sharper recession as the one we are experiencing at the moment. Meaning that they'll most probably need to continue increasing the interest rate also next year, and thus it will make it even more difficult for the economy to grow or to avoid going even into deeper recession. So what conclusion can we draw from this information? We still have a really high inflation rate, which is abnormal. The Central Bank of America will also need to further increase the interest rates in order to try to lower the inflation rates in 2023. The speculations are that it will go to 5%. My personal opinion is that it will go above 5% because this inflation rate is still quite high and it needs to go down. Having in mind that we are having a mild recession at the moment, and the fact that we have a year-long negative market trend now. As I've shown you the S&P 500 as a year-long negative trend, and if they have to increase even further the interest rates, that will not result in a positive swing to that bearish market trend. It will go further down if we have an even higher base interest rates. Having in mind that we now, at the end of 2022, have a stronger consumption due to the holidays, and as we all know, January and February are slower months when it comes to consumption, when it comes to exchanging goods and services. My personal opinion is that we're not looking at positive results in January and February, having in mind that we are also in a mild recession. Although those hike rates have lowered, it will go further, it will go higher, but at a slower rate in order to avoid even bigger or even sharper negative trend. What am I trying to say with this information? At the moment, personally, I am keeping my positions that I have taken. I'm not expanding my portfolio. I'm not opening new positions, since this information is not positive, in my opinion. We didn't see a decrease from the consumer price index. It has increased slightly, but that inflation rate, it's still very, very high. The United States Central Bank will try to decrease it even further. I don't think that is a point of discussion. The question is, if the interest rates, the base interest rates they have set today, what kind of effect they will have on inflation rates. So in my opinion, with those small changes, they're trying to test the market and see how the market will react to those new information. They will watch over the consumer price index now in December and January, and based on that information, they will try to adjust the base interest rate in order to reach their goals. So in conclusion, as I have already said, I'm not making any changes to my portfolio. I'm not opening new positions. I'm not expanding also my portfolio in any way. I'm trying to stick to my guns at the moment and wait and see how that information will pan out and develop in December and January. And based on the results we have in December and January, we will also have most probably another change. It will be either higher, because we'll have a bigger inflation rate, or in my opinion, if the inflation rate stays at about 7%, they will keep increasing the base interest rate at a lower pace, so that they can push the inflation back to 6 and 5%, but at a slower rate, in order to avoid a big market crash or a sharp recession. I hope you enjoyed this video. Give me a like if you liked it, give me a dislike if you didn't like it, subscribe to the Financial Tribune, and thank you for staying with me until the end. See ya!